Hi there, Kathy Spacuzza with Streamline Home Loans in Las Vegas, Nevada. And today I wanted to share more about what LLPAs are and how they are going to impact your business in 2023, especially as we get ready for the spring market. And today we're going to be covering a couple of items and, of course, exactly what are loan level pricing adjustments. So here's what we're going to cover. We're going to cover what are they? Who do they impact and when? What are these new changes coming out? And most importantly, what are the solutions that are available? I'm also going to touch on Home Ready and Home Possible programs, strategies, and solutions, and what you can do to be a resource for your clients. So first up, what are LLPAs? They're loan level pricing adjustments, and they were first introduced in April of 2008 after the financial crisis, and Fannie Mae and Freddie Mac realized that they were undercapitalized and overexposed themselves to risk. So at that time, instead of introducing one standard fee to everyone, they brought in LLPAs or loan level pricing adjustments, and they are still in effect today. Loan level pricing adjustments are a risk fee based assessed to the clients using a conventional mortgage. So, in layman's terms, they're literally adjustments to the price of a loan, and loan prices are what determine a client's rate. So, who do they impact and when? Loan level pricing adjustments only apply to loans delivered to Fannie Mae and Freddie Mac. They don't apply to FHA loans, VA loans, or USDA loans. And for clients, they often pay LLPAs in the form of a higher mortgage rate. LLPAs vary borrower to borrower. It's based on their loan traits, such as loan to value, how much they're putting down, their credit score, their occupancy, whether it's a primary house, a second home, or an investment property, and the number of units. Is it a single family residence or is it duplex? And so the most recent announcements that were made by Fannie and Freddie is effective for loans purchased on or before May 1st, 2023. So these changes are currently being implemented to all the lenders across the country. So what are these 2023 changes? So I've included a snapshot here that's showing you for a conventional purchase loan, and these changes are being introduced in an attempt to re-engage clients who have been sitting on the sidelines, particularly those that may have had a lower credit score or a lower down payment. So essentially, the effective penalty for having such a credit score under 680 is not much smaller than it was. On the contrary, for clients that have higher credit scores and a substantial down payment, they're going to be paying a bit more in this new release than they would have in a previous structure. So to give you an example, so if you look at these examples for a borrower that has a 659 credit score, he's buying a $300,000 home, and he's got a 25% down payment. Prior, he would have been paying 2.75 LLPA, which equates to about $8,250 in cost. Under the new LLPA, that same borrower is going to be paying 1.25% LLPA, which is $4,500. So that's a swing of $3,750 in closing costs. Now, if you look at sample 2, that borrower with a 740 credit score, 15% down, buying a $450,000 house, under the previous LLPA structure, that buyer would have been paying 0.25, about $1,125. Under the new LLPA, that borrower is going to now be paying 1%, and that's going to be $4,500. That's a difference of $3,375. Now note, they've also made changes to the credit bands. So before 720 was considered a really good credit score. So now they're going to change the top tier score. And so conventional buyers with 740 and higher now have an additional change. And so now the top tier band is now 780 and higher. So it really is important that we get the best credit score for that client. The average credit score in America is 713. So that is something to keep in mind that can impact clients that have excellent credit of 740 and above. It's still not going to be the top tier. And one other item that I would like to make note of is they've also introduced loan level pricing adjustments for debt to income ratio over 40%. So if your clients have a debt to income ratio over 40%, perhaps they're buying a home before they sell, that would be an additional 0.50 hit to the LLPA. So it's important to know if you hear from your clients when you have a lender or your clients have selected a lender that has not calculated income at the forefront, it's possible that this adjustment could come into play throughout the loan process. Now, also, keep in mind, these don't necessarily come out of the pocket up front, as the lenders will offer a higher interest rate. But remember, the cost is still there, and it's still technically being paid by them over time in the form of a higher interest rate. Now, this brings me to my next announcement, that on the Home Ready and the Home Possible programs, that all LLPAs will be waived for them. So Home Ready, Home Possible, that's the Fannie Mae Home Ready, Freddie Mac Home Possible, and loans to first-time home buyers with qualifying income at 100% area median income, which we refer to as the AMI, those will be waived. So I've included an example of a snippet of what the area median income. So in Las Vegas, 80% median income limit for the Home Ready, it's going to be $65,360. Now, if you go up to 100%, the area median income is going to be $81,700. Now, we do have an option to go up that high. So the reason I share this, it's going to be very important to communicate to your lender as to why you want to take one spouse off the loan if it allows the lender to use the income guidelines to use one of these products. Both Home Ready and Home Possible have a 3% down payment option. They also have to be a first-time home buyer or a repeat home buyer if they haven't owned a property in the last 3 years. And like I said, 80% area median income. So what are some solutions and strategies? How can you help your buyers prepare for the spring market? So you as an agent, you can set this up and talk to your clients. It's really, 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 really important that one of the most important things that we can do is help our clients get credit improvement. It's going to be imperative to have those conversations with your clients, even if they do have great credit. Any improvement in credit will be beneficial both in rate and closing costs. So make sure your clients are introduced to a lender sooner than they are expecting. Make sure your lender is communicating and offering options for credit improvement. Here, we always look at credit. I always look at the client's credit and I offer them solutions for improving credits and rescores if that's needed. Make sure you refresh your knowledge on seller credits and concessions. This is going to be imperative for those clients who may be closing cost sensitive or who might be limited on their funds. I've also attached a cheat sheet, if you will, in this presentation, so you are aware of the seller credits and options available to help your clients achieve their ideal monthly payment, closing costs, and end up in purchasing. And most importantly, be a resource. Share what you've learned on social media. Use this education to empower and re-engage your buyers that have been sitting on the sidelines. Imagine if you could bring back a client who thought they couldn't afford to buy now, or share that they could potentially be saving thousands of dollars in closing costs. The more you know about these programs, the better. So here is my seller concessions cheat sheet. And if you have any questions, please reach out. Also, I've included links to Fannie Mae's Home Ready AMI lookup tool, and Freddie Mac's lookup tool. Again, I want to thank you for your time today, and I thank you for the opportunity to help you better understand and prepare your clients on these changes. As a loan officer, these are the items that I'm communicating to my clients, and I wanted to make sure you have this as a resource for yourself and your business. And again, if there's anything additional that I can provide, please don't hesitate to reach out to me. My cell phone is the best way to get a hold of me. And again, I'm truly honored and would love to be a part of your growth in 2023.